Hey everyone, it's Mike from Orderflows and welcome back to my channel. Yesterday I posted a video on the importance of stacked imbalances in the order flow. And stacked imbalances is something that I've always looked at in the order flow for as long as I've been trading with order flow for well over a decade. And what I want to introduce you today is sort of a more advanced concept. It's the concept of inverse imbalances. And when you look at a footprint chart, right, you see buying imbalances, you see selling imbalances. Generally, when you see buying imbalances, the market is going up, right? You have aggressive buyers active in the market. And if you have selling imbalances, right, you're generally going to come in on the red candles as the market is selling off, right? Because you got aggressive sellers taking control of the market. However, there are going to be times where you have, a red candle down with buying imbalances or a green candle up with selling imbalances. And people are going to say, how can this market be going up if there's selling imbalances? Or how can this market go down if there's buying imbalances? And, just really sort of rudimentary, it's a case of supply and demand, right? When you see, for example, this red candle here, you see supply coming into the market, it often leaves its footprint, no pun intended, since we're dealing with footprint charts, in the footprint as a buying imbalance, because what you have coming in is you have supply coming into the market, right? Just as on a market that's going up, you like on a green candle, right? You're going to get that selling imbalance. So you have demand coming in here, people sitting on the bid to absorb whatever selling is going on. Now, the E-minis it's an interesting market because it's probably the most widely known futures market out there, and it does a very good job of distributing volume. However, other markets such as YM, the mini Dow, or NQ, NASDAQ, even MNQ, it doesn't have the same type of volume that you have in ES, okay? And in the Orderflows Trader software, we have a setting in there specifically to highlight inverse imbalances. And basically what an inverse imbalance is going to be, it's going to be a buying imbalance in a red down candle or a selling imbalance in a green up candle. So, when you look at the settings, it's right here, okay? Now, you could choose how many levels you want to look for. One, okay, but again, if you're looking at one imbalance in a bar, that could just be a big order going through. I like to look for inverse imbalances at a minimum cluster of two, meaning stacked on top of each other, right? These are stacked inverse volume imbalances. So I'm going to enable this, right? I'm going to keep my same imbalance trigger percent of 400%, 4 to 1, right? And I want to be alerted. I want to draw it out until tested. Now, you can see I have stacked imbalances turned on, but I'll just turn that off right now so there's no confusion between the stacked imbalance and the inverse imbalance. Now, again, like I said, the ES, right, the E-minis is, it's sort of like the benchmark, if you will, for all futures contracts in terms of volume. It's one of those that trades healthy volume, and again, like I said, it's very evenly distributed. So something like an inverse imbalance, while they do appear in the E-minis, right, like here's one right here, you don't see too many of them, okay? And again, not every order flow tool that we've developed is for every single market, and the inverse imbalance tool, if you're trading something like mini Dow, the YM, is something that's going to be pretty useful. So let's switch over to the mini Dow here, and okay, so let's go back to sort of the cash open. This was yesterday, Friday the 11th here, okay, and again it's looking for inverse imbalances. Like here's two inverse imbalances, but they're spread out. Really what I'm looking for is that stacked inverse imbalance. Here's a 2 here, right? It's a little hard to see. Let me expand that up. You got 14, you got 21, but the next bar trades right through it, right? So if I'm looking for an inverse imbalance, right, I want to see the market close down below it, which it did, but I also want to see the next bar start heading lower, right? Not sort of open in the middle of the previous bar's range and then start trade back up into it. That's not what I'm looking for. What I'm looking for, I'll give you a better example here. Let's find one here. Okay, this is a perfect example of one right here, right? This 10 versus 0, 10 versus 0. These are selling imbalances, right, in this green up candle. Next bar opens up, starts trade, comes back, doesn't even really test it. We don't even get down to 28. The high of this is 22, so 6 ticks off of it, and then reverses and starts running up. All you gotta do is you just sit here. You know the high of this bar. You know this bar has this inverse imbalance, right? And then finally it closes here. You just drop a buy stop in here, right above the high here. Maybe a tick higher or 2 ticks higher at 40. Let the market take you in. Goes from 40. It does pull back. Pulls back to what? 30, and even over here pulls back to 28. Okay. But you're long from 40, it shoots up immediately all the way up to 65, pulls back again, like I said, down to 30, back up to 75. Here it pulls back down to 28, back up into the 60s. So it's a nice tool to use for potential quick moves. And I'm not saying that, oh, you got this little inverse imbalance here, it's going to be the low for the rest of the day session. No, right? I mean, you're reading order flow, you're reading what's happening on a very short-term basis, and if you're trading on a short-term basis, your outlook is short-term, right? You're not trading a 1-minute chart to find swings that are going to last for 3, 4 hours, 5 hours. No, you're trading, in this case, is a 1-minute chart, right? You're looking at what's going to happen over the next 10, 15, 20 minutes, not the next 3 hours, right? Because people say, well, yeah, you had the inverse imbalance and it came over here and it failed. Well, this happened at 10:59, 11 o'clock, you're getting in. It's almost 11:30. You should be out of the trade already, right? I mean, people, sometimes they fail to grasp that concept of sort of trading the time frame that you're trading. All right, so let's see if we could find another one here, right? Here's another one right here. See the market shoot up, eventually came down. There's one here. Didn't go up on the next bar. The next bar went up a couple ticks and just sort of pulled back into that, rotated around, and would have stopped you out. Let's look at NQ, right? Give it a second to come up here. And again, on the thinner traded markets, you're going to see them more than on the very liquid markets, because when it's a very liquid market, oftentimes it's got a lot of opportunities to come in and fill that, whereas these thinner markets like NQ that can move a lot, you're going to find a lot more of them. I'm just going back to the cash open time period here, just to sort of go through. Now again, this is a 1-minute chart. You can see there was a nice sell, there was a buy here, then it came immediately with a sell there. Again, you're not necessarily focused so much on what the actual numbers are. This is 810, 811 before the cash opens. It's 1 against 12, it's 1 against 12. In a very broad general sense, these are trap traders here. These are trap traders up there. The market came off again. 1-minute chart. NASDAQ here, let's see. Okay, nothing. This cash open over here. Just then here, okay. You can see this came in right here, right? The 12 against 1. 4 against 19, and you can see, right? It happened early in the bar. Bar opened up here, traded down here. These guys got trapped in here. Now again, you're only talking 19 and 12 contracts. What is that? 31 contracts, and it's not like, oh, these are trap traders, because up here it's trading a lot of volume. So it's not like you got 31 traders that were trapped down here that's going to cause this move because they got to scramble to buy it. Well, they could scramble to buy it. They'll be filled right here. There's 55 contracts trade here, 70 up here. So it's not like, it's 1,000 traders got stuck down there. No, it's only 31 contracts. But you sort of see the shift in the order flow. These guys, really what you're looking for is, any sort of sign of people being caught off sides, right? And again, I'm not advocating and saying, oh, as soon as you become a seller, you become a buyer, because it's only 31 contracts, right? It's not 350, right? This bar traded 1,800 contracts, right? The delta was 259. So in the grand scheme of things, 31 is nothing, okay? But it's really sort of catching the shift in what you're looking at. Yeah, at this time, these traders were stuck in the market, right? And you can see, again, it trades from, 15,108, or 109, 110, all the way, next bar. I mean, look at these bars. This is a nice thing, right? If you trade NASDAQ, I don't, but I know a lot of my users trade NASDAQ, but, you get those big moves like that. Okay, I mean, there was a few others. on Friday. I'm just scrunching this like it's a little easier to see. The problem with NASDAQ is it trades so much volume. Here was a buy, but again, didn't go higher. See it right here, expanded up, right? This bar, the next bar didn't go higher. Here it did, and just sort of rotated around. This was a sell, but again, do you really want to be taking a sell into the lows of the day? Probably not. Besides, the next bar didn't even go any lower, right? You want to have this inverse imbalance, and you want to be trading lower in the next bar, not sideways to higher in the next bar. Okay, just see. Here was a nice buy here. This was a deeper one, right? For price levels, right here. And you see the market, from basically 80. 83 all the way up to above 100 and even higher. Here was a sell. Didn't really, next bar shot down, then sort of pulled back. Here was a buy, but it didn't go any higher. Here was here's another buy, right? 10 against 2, 10 against 2. Next bar doesn't go any higher, but then this bar here finally breaks out. Again, from 77 all the way up, again back above 100. So don't just think in terms of the normal buying imbalances and selling imbalances. We're appearing in green candles and red candles. You got to start thinking outside the box when it comes to dealing with imbalances, because if you were just going to ignore these two selling imbalances in this green candle, that's nothing, coincidence, whatever, you'd miss this beautiful 30-40 point trade right here, right? So again, when you see these inverse imbalances, pay attention to them, right? Our Orderflows Trader software, we've had this in there for well over a couple of years, 2-3 years. And again, if you're trading a market like NASDAQ or mini Dow, MNQ, you're going to see them on a daily basis, because they do happen often, right? I mean, markets like gold, etc., they're going to appear there. So might as well, have some software, have a tool that's going to help you identify them and take advantage of them when they occur. Because, that's the whole point of using order flow, right? Because, out of all the people that trade out there, people that look at a footprint chart, it's really, minuscule, a percent, maybe 2 or 3%, if that even. Everybody else is looking at bar charts. They're not going to see this happening, this change in flow, somebody coming in here with some support buying to, help support this market as it continues up. So anyway, I hope you guys got something useful out of this video, and I'll see you guys on the next video. Bye-bye.